you know, that value add would actually, you know, have a higher coefficient of variation and opportunity. It should really, you know, fit right in, and it, you know, doesn't, but it should. Now, curiously, when you take a look at this, there's definitely a quantitative difference in risk between opportunity real estate investment. Stop to think, that's all speculative development, greenfield, brownfield, right? Total redevelopments, zero cash flow, entitlement risk. So you at a certain point, yes, historically you've demonstrated a higher return, but you're definitely assuming more risk than with liquid securities, okay? I plotted it, you know, it doesn't really show anything. So anyway, I thought that was kind of interesting. I just want to show one other thing for a couple of minutes, and then we'll leave early if you want. Like 8:25. Alex?
For my report, should I go back and I did the standard average? Should I go ahead and do the geo average as well?
Geo mean?
Geo mean, I mean?
Well, we already said geo mean is a lot better way
Yes.
of doing it, so yes.
Did you answer your own question?
Yeah. Well, Phil already.
Or it may not be a difference if you don't have any names.
Hey, this was a presentation that was put together by Dietmar and sorry. So he's one of the guys that runs GLL. Okay, GLL is like an ultra core fund, private equity group out of Germany, and they invest in Class A, CBD, office buildings in 24-hour cities in the United States. Curiously, there's some slides I'm going to show you. What is the purpose of research? Convert data into actionable information. Into action. So it's not to just fill papers on a report, okay, and give it to your boss or to your instructor. Okay, the purpose of research is to convert data into actionable information, okay? So, here was this thing that he was saying, look, we're constructing an office portfolio, okay? We already have a building in San Francisco. Where might we want to invest if we want to be diversified? What would you do?
You gotta look and see what areas, maybe like, obviously since you don't have really anything in the south, maybe start there and just kind of see what.
Okay, so that's naively. If you want to do it quantitatively, what would you do?
I'm saying to see where, like San Francisco, Los Angeles, where they are in the market, and see if there's any other markets that flow with them.
But what? How do we do that?
Through data.
What data?
Research.
Okay. What research?
Market.
We've talked about all this stuff. Demographics, that was last class. We're here doing correlation, okay? How about determining correlation of rents from one market to another? If we assume that rents ultimately drive NOI, that might be, so can we ultimately find where rents correlate or don't correlate?
Yes.
Maybe we could do that, right? So how do we measure? So this guy, time series, okay. So what they do, and this is something they do, right? They sit there and put rents per square foot, right? And do a grid of markets and say, hey, and they come up ultimately with correlation. Let me go to, hold on. And so ultimately, what?
How did that graph? How did that chart work?
It was a ratio, right? Like Atlanta to Boston.
Correlation was defined as the product of the variances from one market to another one divided by the variance of one market multiplied by the variance of another market mathematically. If that's what you would like, you'd like to see the formula?
No. I was
okay.
It wasn't showing different.
Okay,
So
so,
this is saying
okay, but
seven-
hold on. So that's going to give you, that correlation is going to give you the relationship. Okay, so just stop to think, right? So you've got an observation less a particular mean, right? And you do this for all of these observations and markets, right? Okay, divided by, right, A and B, right, by the variance of A, multiplied by the variance of B, okay? And what this gives you is a factor somewhere between 1 and -1, okay? And -1. It's going to give you a factor here, right? Okay, and that's going to tell you, so they color-coded, right? So obviously go Atlanta, Atlanta, Boston, Boston. That's why you have a correlation of Atlanta to itself.
That's what I
Okay,
didn't.
okay, the correlation of Atlanta to itself.
How are you comparing yourself?
So, but then they start putting green, is we're saying, hey, look, these are cities we're interested in where there's very low correlation. Pittsburgh, 0.45. San Francisco, 0.36, okay? And so ultimately what they do, the mechanics aren't important. I'm not teaching statistics in this class, but here's a private equity group that is saying, Irene, please.
I'm not, I'm just telling what you said.
Okay? What they want to identify assets in markets that have low correlation to markets where they are, right? And why? Because we found out this morning that Mr. Markovitz had a point, that if we can find assets that have low or negative correlation to one another, we can maximize return or minimize risk. So they take this data and then they go, hey, so things that are red are highly correlated markets. Weak choice for diversification. Lower correlated markets. Strong diversification. All of a sudden you see Los Angeles has a 0.36 correlation factor to San Francisco. Boston is 0.90. So Boston seems to function kind of like San Francisco. So if you want to diversify and you already own a building in San Francisco, do you want to buy another building in Boston?
No.
Where are you going to look?
Boston.
And you can go surfing too,
Makes no
you
sense,
know? So now, that may be counterintuitive because you think geographically those two markets should perform the same. Is that what you just said?
Yeah.
I said geographically doesn't make any.
But the fact that the geographies are proximate doesn't mean that the underlying economies are similar.
Of course.
Okay? Or that the market, the supply and demand paradigm in the rental markets, you know, is the same. Yes?
Wouldn't you still not want to do that, taking into consideration like legal? So if the state changes something, you're still in the same state.
Well, I mean, you have to identify what the risk level really is. Well, but those are all, listen, I'm giving you mathematical.
Right.
Yeah, there's so many other things that go into it.
And as Kyle said earlier, this is an input.
Yeah.
This isn't a gospel, this isn't the Bible,
As you start.
this is an input. But if you do a time series, if you do that correlation over the last 3-year period, and this is what you're finding, it's not going to change overnight. Now, there may be geographic reasons why you don't want to put it. There may be legal reasons why you don't put everything in one jurisdiction. If you're an international fund, maybe you're going to have limited national exposure to X amount of the fund per jurisdiction for things like that. I don't know about states. Maybe geography, we don't want to have more exposure to earthquakes or windstorm or whatever, okay? So, but here is a company that's taking data and trying to make a measurable, okay? So, you know, he asks a stupid point. He goes, Derek Jeter hit 273. Is that good or bad? What have I always said with data in our classes here, Emmanuel? What have I always said in our classes about data? Okay, why do we collect data? Why do we measure data? To benchmark. To benchmark against what?
Over time.
Past, our past behavior, our expectations of the future, and against our peers, right? So, is 273 good or bad, Matt? Are you a baseball guy?
Not really.
Is 273 good or bad?
Right now, yeah, that's good.
You think it's good. What is it? Your batting average? Just every time you go up the bat.
No, just slightly.
Well, he said right now, like.
Compared
Oh,
to
that's good.
Yeah, no, that's a good batting average.
So we got people saying good.
compared to Derek Jeter in the past, that's bad.
I would say
Wow.
a guy that's supposedly like a 273, that's junk, but you know, whatever.
I don't know.
Since they took roids out of the game, you know what I mean?
No, so,
Do not talk bad about Terry.
now, is it good? Is that good compared to me?
Yeah.
Hell yeah, you know. Okay, no, but then that's where, so then you go and you say, hey, so first question is, where was he? Dude, this guy was like, his career batting average is 313. So is 273 good?
Nope.
No, not at all, right? So just compared to his history, that's not good. You're benchmarking to the past. Now, I don't know if he did it. I don't think he did. You can also compare, there you go, he's comparing to what's the National League average, what's the American League average. So that the average of all the players is at around 250. GPA of 2.5. Average. Okay? All right? He's got 273. So is he good compared to the average? Heck yeah, right? You'd hire him every day of the week, right? So, you know, how we use data, okay, all right, Atlanta's current office, you know, vacancy is 15.7. Is that good or bad? What do we compare it to?
Longitudinal data.
How was it before,
Exactly.
right? And what is it like in other cities? Okay. Now, with development, there's a whole bunch of other subjective factors, which are, you know, what's a pipeline, right? Because it could be historically low, and they may be about to dump, you know, 40 million square feet into the market, which is totally going to upset that number. You can't just look at data in the absolute, right? So, you know, in their particular case, right, they do a timeline, right? Historical averages are 13.3. So at this point in time, the vacancy factor is higher. Now, you can again draw conclusions there, right? You could look at one of the reasons you chart things is you visually see it. It looks like it's trending down. Maybe it's a good time to buy because NOIs are lower. We really do have mean reversion. Eventually that vacancy is going to come way down. So buy high, sell low, but price-wise, buy at a lower price, sell at a higher price, right? U.S. average, so you know, okay, but you know, you can compare it to another city, Emmanuel.
Just out of curiosity, how would you adjust for, let's say back in 2000, you had about 14% vacancy, and in 2013, you had 16%. But in 2000, you had like a smaller square footage of building versus right now,
Well,
you have more.
Okay, so, I mean, that's supply. Supply is an important component of the analysis in real estate, okay? When you use percentages, you're taking away that concept, right? Because you're using the percentage of the total space as the factor, right? It's an absolute. So, conceptually, if you have 100 million square feet one year, and 20 years later you have 200 million square feet, there's been some sort of economic growth that's justified that, and I should be able to compare vacancies, you know, at the same time. Now, you can't really do that because maybe there's been overbuilding, and maybe all of a sudden vacancy's way up because there's been overbuilding, okay? Or it could be the other way. Vacancy may be lower. There's been a lot of buildings, but they haven't built enough, okay? So you've got to consider the supply equation in real estate. You can't just look absolutely at a vacancy factor. But that factor should hold constant in equilibrium over, you know, a long time series, okay? Because people would build, people would not supply if there was an underlying economic justification for building. You know, again, so you can, you know, go and then not only compare to national, compare to other markets, right? Well, you know, curiously, Pittsburgh had a very low correlation to San Francisco and has very low vacancies. You know, that's something else that you could say, hey, you know, maybe, well, maybe nobody from Pittsburgh, who wants to go to Pittsburgh, you know, like, right, so, but anyway, all right? One metric's not enough, you know, in their particular shop, they use price per square foot, cap rates, absorption, pipeline, things we just talked about, supply, right? Who are the data providers in real estate? There's a whole bunch. This isn't a market analysis class. You recognize some of these names. CoStar is huge, okay? Do you guys have access to CoStar?
Yeah,
You do now as students?
we do. I use it for work.
We do.
We don't have
Still have
access.
it?
I,
Yeah,
some
you
do and some
Oh, I
don't,
have
depending
access.
where
I
you're
think Chad
starting.
and I have access because it took like it took us. I got my access 3 months after I joined the program. It just takes forever to get access, but you do get access.
Okay, I got access and then they took it away, so I don't have it anymore.
Oh, I mean, my student account still works.
Period of time, it's not for
Okay.
short.
Well, as an instructor, we had to deal with them once, but anyway, great data for especially leasing information, okay?
You have
So I got a broker going, okay.
well,
It's data.
You have to if you confirm the data in CoStar. Trust me, I know.
I understand, I understand, I understand. But that's time and that's cost, right?
No, it is, but
It's-
I mean, I made a big mistake listening to CoStar once. I was like an idiot and stuff.
Okay, well, it's all, listen,
I didn't used to
listen,
that,
listen, CoStar, Reese, we've talked about Reese before.
We had it, they took it away.
I know, well, you mentioned that. Real Capital Analytics,
Yeah.
free stuff, JLL, CBRE, HFF, Cushman and Wakefield. Some large brokerages provide a fair amount of free market data. And if you take the due diligence class next month, or next term, I'll go over some of that stuff. But anyway, there's a lot of stuff out there. Larger tenants, you're trying to do credit analysis, S&P, D&B, Moody's are also important sources, okay? These are just things that, you know, so that's Real Capital Analytics for transactional data. I use some of that in the class, right? This is, in their particular case, they provide research to the guys that ultimately raise the funds back in Germany. You know, they're buying here, but they're getting the money somewhere else, okay? In a lot of cases, in this country, we have funds that invest overseas and it would flow the other way. There would be people in the ground in Germany or England that would be supplying information for the fund or asset managers here, okay? I don't want to go through, this is some internal mumbo jumbo that they did. I didn't like any of that. This is, again, more mumbo jumbo stuff that they did, but there's a couple of things here that were important. Right, so,
That's mumbo jumbo there.
no, yeah, but forget the mumbo. Okay, so it's sort of like which market has, you know, the worst trend, right? And so if you just look here, you'd say Seattle's kicking ass, right? Now, he used a timeline from 2000 to 2012, right? And all of a sudden he compresses it from 08 to 12, okay? And all of a sudden you see that what looks like is going up is really going down. The specific period of time that you show on the chart may be different depending on what you want to show. And people play these games all the time, okay? So he does the same thing with rents per square foot. And this one is, he's using in dollars versus percentage, okay? So it looks at percentage like they're much tighter than they are in dollars. Which one's more relevant? Which one's more, he's comparing two markets, okay? Yeah, hold on. This one. This is another visual one that's good. Here's, I never use these charts, but what he points out here is if you visually look at this, it looks like the purple is bigger than the yellow just because it's higher, right? they just redid the back of our church, and there's 2 statues on either side of the altar. And a guy asked me the other day, the same thing that I thought. He goes, "Hey, is the Joseph higher than the Mary?" and I actually counted the number. They got like tiles there. I counted them, and it's the same. You know what the difference is? Joseph is bigger than Mary, and so from way in the back of the church, it looks like one is higher than the other, but they both start at the same place. It's just one is taller than the other one. So what he points out is that the yellow is actually much bigger, but since it starts lower and ends lower, at quick glance, you think the purple is a bigger guy. You know, he's just showing that. Well, whatever. This is the one. This is the one. Well, yeah. Listen, I forget, the lesson here is you can play with charts and with the indices and get whatever result you want. Okay, now, hold on.
By the way,
Okay, clear your desks and no. Oh, Rebecca, I had you. You're white, you turned white as a goat.
Reminds you of accounting. Clear your desk, pull out a piece of paper, you're ready for a 20-question quiz.
is that a deep mark for the teachers here?
He doesn't teach here, he's actually now, I think he's doing as an adjunct, he's teaching at UCF. He's done an undergraduate class, he's created an undergraduate class in asset management. But no, he does not teach here. He used to make one presentation a term.
I know what deep mark is. I don't know what deep
Okay,
mark is.
listen, thank you for your time. I hope that the class today was educational and helpful. And I hope that those of you who have presentations do get on the call on Tuesday. If all goes well, I'll be able to send out the go-to-meeting call. If you can't get on the call, that's okay. Send me your outlines. Don't start doing a lot of work without an outline. Feel free to send me stuff, and then when you start getting closer to where you need to be, then I'll start manipulating a little bit more, giving you
I
ideas.
sent you out this morning, but I'll go change the next round.
Okay, and that's it, really. Have a great weekend, have a
You
great
too,
week.
thank you.
Can you please initial the final? Yeah, final.
I'll send you some suggested questions, yes.
For the final, and then.
Oh, and my daughter, man.
Yeah.
It's her birthday.
I think it's in the class. Can we do it in Michael? No, just this section.
There's so many one place that I go to and live with kids. What's that? Don't be lying on your daughter. Get a straight from get a cash. I thought they closed that 240.
You can make them try to start it.
What it do? Hey, so watch the hood. I'm like, is that a technical term? You should see me trying to explain the corner store to someone. You see, he had a glint on his face. He had a glint off the face. I can't believe it wasn't a script.
Whatever, I don't care.
We do need to.
For the shirts, you're supposed to make them.